back, everybody, to Passive Income Lifestyle Series. I'm your host, Travis Watts, and disclaimers as always, never financial advice, not telling you or anyone else what to do, informational and educational purposes only. So with that top of mind, pigs get fat and hogs get slaughtered. We're talking about greed and locking in profits. Do I have you confused? Probably, but that's okay, because that's what we're going to dissect in today's episode. So here's the deal. A little bit of greed is okay, especially given that we all live and work in a capitalist society here in America. It's the hog or the person that gets overly greedy and tries to take too much in that gets sent to the slaughterhouse. Now, if you're a studier of Stoicism, or if you're familiar with Stoicism to a point, they talk a lot about the four virtues: wisdom, justice, courage, and temperance. And temperance is essentially moderation. Okay, they use a lot of the example, because ancient Rome 2,000 years ago, of winemaking. So the symbol for temperance is somebody who's making a barrel of wine and adding water to it to effectively water it down. So moderation can obviously be applied to a lot of different aspects of life, such as, should you eat fruit every day to have a balanced diet? Maybe. But should you only and exclusively just eat fruit and nothing else? No, that would probably be a bad health decision. Another example would be, having a glass of wine at dinner, fine. But should you have 10 glasses of wine every night for dinner? No, that's going to have major health complications, more than likely. So temperance and/or moderation can be applied in terms of greed. Usually overly greedy people end up on the losing end of the spectrum. And I'll share a quick story with you, my own personal story. Years and years ago, I was making an investment in a private equity deal. This was non-real estate related, but it was a private equity fund. And I'm looking at the projections, okay, the anticipated returns, and they're forecasting over a 20% annualized cash-on-cash return from day one, right out of the gate in the first year. Now, I looked at that at the time a bit naively and thought, okay, that's really strong cash flow. I'm not getting that from my multifamily deals or from anything else that I've been investing in. So I put about 3 times as much money into this particular deal than I otherwise would have if it were just any ordinary deal that I was doing at that time. Long story short, it ended up being, unfortunately, a Ponzi scheme, and I ended up losing an awful lot of money, but there's nobody to blame except for myself for being too greedy. So lesson learned. So let's imagine just for a minute a teeter-totter, and on the left of the teeter-totter is being extremely conservative. We're talking about hoarding cash, putting it in your bank account, shoving it underneath your mattress, not wanting to take any risk of any type. And on the right of the teeter-totter, we'll look at extreme greed and trying to outperform everybody around you. So as investors, we need to learn how to balance the teeter-totter. And one way that we can do that is by locking in profits. And that, my friends, is the heart and the point of this episode. So let's say that you had invested $10,000 into a stock or into a cryptocurrency or something like that, something that's very liquid and publicly traded, non-real estate example. You put $10,000 in and now it's worth $20,000. We'll say a few years down the road, it really did well. So first of all, you're taking the most amount of risk on day number one. It's the day that you took the $10,000 and you made the initial investment, not knowing if it was going to go up or down, and having not received any form of capital back through distributions or dividends or passive income or anything like that. So now that your valuation has effectively doubled, there's a couple things you could do with something that's publicly traded. The first thing you could do is consider selling off half of your holdings, half the shares that you own, because what that would do is effectively give you back your initial investment and take risk off the table. So you would still own 10,000 and let it ride. It would maybe go up or down or sideways. I don't know what would happen in this scenario, but the point is you would put 10,000 in and you had got 10,000 back. So you've significantly reduced risk by doing that. The other thing you could do in the example of a stock is set a stop loss, which is an automatic way to sell off a portion or all of your shares at a specified price. So you could say, look, I bought these shares at $10 per share. Now they're trading at $20 per share. So if it dips below $19 per share, go ahead and sell me out and just give me my profits. Or set a stop loss at $10 per share when you first got in. And that way, if it crashes and comes all the way back down to where you got in, at least you would have your money given back to you once that stop loss gets executed. So something to think about, but it's one way to reduce risk. Now, in the example of real estate, because we mostly talk about real estate here on the show, let's say you bought a piece of real estate or got into a syndication or something, and the valuation went way up. It doubled over time. So you could potentially do a refinance where you'd put a new loan over the old loan. And if there's enough equity there, you might be able to, cash out, refinance basically, and give the investors their capital back or something like that and continue holding the property. That's a huge risk reduction strategy. The other thing you could do is just simply sell. Just say, look, we made a lot of money. Let's sell and let's go repeat this process again with another property. And that's what we do at Ashcroft Capital. Every dollar I get back is effectively reducing my risk. For example, if I put $100,000 into a real estate syndication or private placement and a couple of years goes by and I've received $20,000 through cash flow distributions over the years, the way I look at that is I've reduced my risk by about 20%, because at that moment in time, having collected 20% of my money back, my max loss would be 80% of the remaining capital. So if the whole deal went south and everybody lost all their money, at least I would have had the 20% plus any applicable tax write-off or something like that to show that I lost money on an investment. On the same note, this is why I do not invest in new development projects in real estate. There's nothing wrong with any operator that's doing new development. There's nothing wrong with that business plan. The point is, it's got a higher risk profile associated with it, and I'm not comfortable with that risk profile, because with new development, I have to send in that same example, my $100,000 and hope that in 4 or 5 years, they were able to do everything on budget and on time and that hit the valuations they were looking to hit. And in the interim, I'm not usually receiving any kind of distributions or cash flow because it's not rented out, because it's not built yet. So it's a higher risk, higher reward type of business model as compared to what we do at Ashcroft Capital. At Ashcroft, we're buying existing older communities that already have been obviously constructed and have renters in place on the day that we purchase them. So even if we closed a property and we did nothing to it, we just bought it and managed it and looked at it, it would be producing cash flow and income right out of the gate in year number 1. And then to take it a step further, we do a value add business plan, making it nicer and newer so that it'll compete with some of the luxury and higher end apartment communities in a particular market. And so we're adding better quality of life, living conditions, modern amenities and updates, and a safer community, quite frankly, to the residents. And we're adding value, obviously, to the property itself, because we're polishing it up and we're painting it, and we're fixing problems, and we're putting on new roofs or, parking spaces or whatever we're doing on the particular property. So that adds value structurally. And then we're adding value to the investors, you and I, because when we renovate, we can now justify raising the rent because it is a newer, nicer, safer apartment community to live in. And so that helps boost the revenue and the cash flow to investors. So that's how we add value there. So with that in mind, I digress from all the real estate examples, but the key takeaways I wanted to leave you with in this episode is just to remember not to be overly greedy and to look for opportunities to reduce your risk as you go along your investing journey. I'm Travis Watts. You're listening to the Passive Income Lifestyle series right here at Ashcroft Capital. If you ever want to reach out or have questions on this episode or anything else on the channel, you can reach me at Travis at ashcroftcapital.com. Thanks for watching. Have a great week, and we'll see you in the next episode. Thank you for checking out our YouTube channel. To stay up to date with Ashcroft Capital or to view current offerings, please visit avaf3.com.